Okay, now we're talking about Florida's Greenbelt Law, and the purpose of Florida's Greenbelt Law is to protect farmers who are using their farmland for agricultural purposes to be subject to excess taxes because the value of their property happens to have increased due to its proximity to urban growth, urban development. Because the land next to expanding urban areas becomes more valuable and subject to higher taxes, and that would be unfair on the farmers. So as long as the land is reclassified once a year and it is used for agricultural purposes, then it'll be taxed not on its highest and best use, which could be, for instance, being sold as a subdivision, but on its actual use, what it's being used for. So it's based on the actual uses being used for right now. Protects farmers, but it does require annual reclassification, the Florida Greenbelt Law. As you saw on the tax bill earlier, we do tax each of the districts at a given rate, and these rates are called mills. It is basically, we will actually tax you so many dollars per $1,000 of taxable assessment or taxable rate. The mill is 1/1000th of a dollar, and we express our tax rate in mills. There's a 10 mil cap on city taxes, county taxes, and board taxes, school board taxes. Give you an example. Here it is. Here's the a copy of the tax bill we saw earlier. And we have a taxable value of $34,000. Therefore, the first district is being taxed at $5.5982 per thousand. So literally what we do is we multiply the 34 by the 5.5 divided by 1,000. So here's the example we have in the book. Home is worth taxed at $350,000 assessment. Also, the taxable value is $350,000. The taxes on the school is 6 mils. City is 7.1 mils, and county is 8.2 mils. Look at the school taxes. We only take the first 25,000 in exemptions. That leaves us from 350. That leaves us with 325. So that'll be the taxable value on the schools. We multiply that by 6 mils, and that's what we do. We turn it into a decimal. Or you can multiply by 6 and divide by 1,000. Same thing. We'll get that figure. And we do the same for the city and county. But we add those together because they're going to both be subject to the $50,000 exemption. And we take the $50,000 exemptions away from the 350, and we get 300,000. Multiply that by 0.0153, and we get 4,590. So the total taxes would be $6,500 on this $350,000 property. And we have another example there where they ask us, what is the savings if I homestead my property? If I hadn't homesteaded my property, I wouldn't have gotten those $25,000 worth of 6 mils, and I wouldn't have got that $50,000 worth of 7.1 plus 8.2 mils. So what are those savings worth? So simply we multiply the 25,000 by 6 mils to get the school savings, which is 150, and we multiply the 15.3 mils by the 50,000, and we get the 765 savings on the city and county taxes. Add those together, and had my property not been homesteaded, I would have paid an extra $915 in taxes. Always remember to look out for whether the owner is blind or widowed or any other extra exemption. So, for instance, on this $165,000 home with the school at 6 mils, we would have added the 500. So the total exemptions wouldn't have been 25,000, but they've been 25,500, and giving us therefore a taxable value for the school district of 139,500. Same with the city and county. 165 minus the 5,500 because the owner is blind. And that's how we'll work out the taxes in that case. We do have special assessments. Special assessments is when the city or the county come along and make some improvements that benefits your lot, your home. Could be they improve the street outside, or it could be they put in sewer lines or public water system or public water lines or so forth. They want you to help pay for those improvements. So they assess you at the end of the year under the non-ad valorem section of the taxes. That's just below where all the others are, and you will have to pay this. This is called a special assessment tax, and it is a superior lien, second only to property taxes, and it's levied on a front foot basis, or when it's used for street paving. In other words, how many feet does your property take up on the road, or a per hookup basis if you're talking about sewer lines or water lines and stuff. Special assessment calculation. They're talking here about a lot measured 120 by 435 of 325. Always remember that the first number is the frontage. The first number is always the frontage. So lot dimensions written with frontage first, then depth of the lot. Calculate the front feet times the cost per linear foot equals the total paving cost. Linear foot is literally if you had a piece of string and drew it or pulled it from one corner to the other, not necessarily following the contour. If you had a curved property, for instance, or a wavy property line, it wasn't absolutely a straight line. Linear foot means that. I'll give you an example of how we do this. Here we have three houses. We're looking at the middle house, which is 100 feet wide. 100 foot frontage. It's got mud road in front of it. The government come along and say we're going to put a tarmac road in front of your home. We will pay 30%, the government says, the city. It costs $24 per frontage foot to build this road. We expect you to pay 30% of that. Sorry, we'll pay 30% of it, and the owner pays 70%. So you're going to pay 70% for the cost of putting this road down. So first of all, we have to know what the frontage is. Well, we know it's 100 feet, and therefore we're going to be paying 100 times 24 times 70%, which comes to 1680. But the thing is, there's people who live on the other side of the street, and they can pay their fair share as well. So what we do is you always divide that by 2. So in a question, if you forget to divide it by 2, you're going to get double the answer. That's going to be one of the wrong answers. We have to pay our taxes by April the 1st. If not, they become delinquent and can be sold at a tax sale in June. People are invited to come along and buy these certificates. The person who quotes the lowest interest rates that they will charge the property owner will receive the tax certificate after paying the tax amount plus interest plus cost, 18% maximum rate. So it's the one that bids the lowest interest rate. I'm trying to be fair to you. You can the bidder will then send the delinquent owner notification that the bidder is now the owner of the tax certificate, and the homeowner can go to the courthouse and pay off that certificate. It doesn't send it directly to the bidder. They pay it to the courthouse. Then the bidder will receive that payment plus interest from the courthouse, and the certificate will be cancelled. So this is just a form of investment by an investor. Goes along and buys all these tax certificates. If after 2 years, but before 7 years, the homeowner has not paid off the taxes, then the bidder can apply for a tax deed. And this is done by putting the home up for sale by the court, and if no one bids on the home, then the tax certificate holder will receive ownership of the property through a tax deed issued by the court. If the home is sold at the court sale, then the certificate holder will receive from the proceeds the amount owed to clear the certificate debt, and the balance will then go to the home owner, the old home owner. We do have some benefits for owning a property when it comes to personal taxes. At the end of the year, by April the 15th, if we itemize as opposed to take the standard deductions, then the home owner can deduct mortgage interest on the principal home and second home, pay property taxes on the principal home and a second home. Deduct property taxes on the principal home and second home. If you are a first-time home buyer, you can deduct up to $10,000 without penalty, though you do have to pay the taxes from your IRA as a down payment on the home. And if you should sell your home, you are excluded from up to $250 or $500 if you're married filing jointly from capital gains. Also, we can deduct from our taxes interest on a home equity loan of up to $100,000, and we can also deduct mortgage origination points and discount points. These are deductible in the year that you paid them. Unless it's a refinanced loan, then the points are deducted over the life of the loan. So when we actually sell our property, any proceeds that we get above what we paid for it, we will actually have to maybe pay capital gains on. Capital gain is the profit from the sale of the property. Taxable gain is determined by the amount actually realized from the sale. This is sale price less the expenses of the sale. The adjusted basis is what we originally paid for the home, plus expenses of the purchase and capital improvements. And the capital gain, the amount realized less the adjusted basis. So what we'll do, have a look at an example here. The home costs $190 and the owner spent $15,000, so his total adjusted price is $205,000. The $15,000 may have gone on a capital improvement like a swimming pool or something. So throughout the life of the owner's ownership, the home cost him $205,000. We don't take into account maintenance, repairs or other costs. Just capital improvements. So we sold it for $265,000, but it cost me, say, $13,000 in commission plus $1,100 in closing costs. Then, although I sold it for $265,000, out of the sale I actually got $250,000. Now we look, the home has originally cost me $205,000, so the difference between the $205,000 and the $250,000 is my capital gain, $45,595 in this case. So that would be what I would be subject to taxes on normally if it wasn't my principal residence. And because it is my principal residence, and I'm allowed to exempt up to $250,000 or $500,000, so therefore I wouldn't pay any taxes on my capital gains. If this was a rental property, one I wasn't living in, then yes, I would. And I can only do this once every 2 years. If I'm selling it after 1 year and I've got a reason like I moved jobs or ill health, then I may get a pro rata share of the $250,000 or $500,000. If we are purchasing a property from a foreign seller, someone who isn't a resident or citizen of America, and what we have to do is pay a little bit of tax or put aside some money for the taxes. So we call it FIRPTA, Foreign Withholding Property Tax Assessment, something like that. The purchase of the U.S. real property from purchase of U.S. real property from foreign sellers. Aim is to prevent foreign sellers from avoiding to pay taxes, because the seller may come in, sell the home, get the money and go away and not pay the taxes. So the IRS does require, through the title company, that buyers hold back 15% of the gross sale price. Buyers must report the purchase and pay the IRS the amount withheld. It's quite a complicated set of rules. This is just a very, very top part of it. Just remember the 15% foreign sellers FIRPTA. And then the seller will eventually put in his tax return to the IRS, and if any taxes are due, they will be withheld from that 15% rather, or it will be returned to the seller. When it comes to selling income property, we also have to take into account the taxes we would pay at the end of the year. So let's just pop back to how we work the income approach. Remember, we have PGI minus vacancy losses equals EGI, effective gross income. Fixed expenses minus the fixed expenses and the variable expenses minus the reserves or replacements gives us our net operating income. This is the income that we would report to the taxman at the end of the year. Now we do know that in this there's no mortgage payments or so forth. So if we look to see what we show to the taxman, just remember that deductions from the gross income from investment properties, we have to take into account operating expenses, any financing expenses, and any depreciation. So if we look to see what we give to the taxman, first of all we give our NOI. Hey, Mr. Taxman, this is how much money I earned with this property. He spots that bulge in my pocket and says, what's that there? He says, well, that's my reserves for replacement, but it's cash. I still got it. Therefore, I got to pay taxes on it until such time as I use it as actual operating expenses and take it out of my operating budget for my building, which would reduce my NOI. But I haven't spent it yet, so they do want me to pay my taxes on the reserve for replacement. So what we do, we add that back in. So remember that. But they do allow me to deduct my interest on the mortgage payments that I made on the property throughout the year. And there's another thing they allow me to do is depreciate the building over a certain number of years, depending on what type of building it is, and use that depreciation per year to deduct from my income the amount I have to pay taxes on. So what we do, we deduct depreciation. And then we finally come up with our taxable income, and then we would pay whatever our rate is, depending on how much we've earned on that taxable income. So the NOI plus the RFR, the reserve for replacements, minus the interest, minus the depreciation, gives me my taxable income. So first of all, we have to remember we do not depreciate land, so we cannot claim depreciation on the land. On the actual improvements on the building itself, we can take a straight line depreciation. So whatever we paid for the property, we would divide that by 27.5 years if it's residential rental property, and that will give us how much our property depreciation is per year, in the same way as we did that earlier for our income approach on homes. And also 39 years for non-residential income producing property. So to give you an example here, the total cost to acquire the property minus the value of the land. We have to know what the value of the land is when we purchase the property. Gives us our depreciable basis. And then we divide our depreciable basis by what our useful life is, either 27.5 or 39, and that gives us the allowed amount to deduct per year of our taxes. Here's an example. We bought a building for a property for $250,000. It's residential. We've determined by appraisal that the land is worth $50,000 and the building is worth $200,000. Therefore, what we'll have to do is use the 200,000 and divide that by 27.5. That means I can depreciate this property 7,273 per year. And that would be that figure here. And that will lower my taxable income down by that much. Here we have another example of a commercial building, offices. Therefore, and it was valued at 2.35 million. The land was worth 250,000 million. Therefore, by deduction, the building is worth 2.1 million. We divide that out by 39 years. It comes to $53,000 a year I can deduct as depreciation of my taxes. When it comes to capital gains and losses, I can actually work one against the other if I have separate buildings, separate investment properties. Let's supposing on one property at the end of the year I lost 15,000, but on another building maybe I gained 10,000. So my net loss for the year was 5,000. Well, the IRS only allow me to deduct 3,000 of that per year. So in that particular case, I can only deduct 3,000 of my losses against other income that I had. And then for 2,000 of the losses can be carried forward to next year's taxes and so on. And how do we work out what is the capital gains and the losses? When we sell our capital assets, then if it's sold for more than its basis, it is a capital gain. In other words, if I sell it for more than I actually ended up spending on it through the ownership, my life of my ownership, then it's a capital gain. If it's sold for less, then obviously it's a capital loss. Capital losses can be used to offset capital gains for tax purposes, but loss on the sale of a principal residence, in other words, it's not an income property, is not a capital loss. You can't use that against your taxes. And capital gains are taxed at the applicable capital gains tax rate, whatever that is, usually 20 or 25%. They won't ask you that. I think I've just done that one there. What happens if we sell a building, but we're not being paid all the sale price right up front, but it's been paid over a number of years, for instance, in an installment plan? I don't have to pay all of the capital gains taxes at the time of the sale because I haven't received all the money. So basically the IRS says whatever you receive, let's supposing you were receiving it over 5 years, so you get 1/5 of the sale price every 5 years coming into you, then you pay taxes on what you receive. So the gain is received over a number of years in an installment sale. Then the seller pays capital gains taxes as the gain is received, and all capital losses must be reported in the year of the sale. We also have another method of avoiding or delaying paying taxes, and this is called a like-kind exchange. I can, for instance, if I sell a property and I have a lump sum of money, the IRS will want to tax it. But if I say, no, I promise that within a certain period of time I go and buy another income property with it, then I don't have to pay taxes on it. So this is called like-kind exchange. I'm swapping real property for or real property proceeds to buy another real property. I could be swapping a factory for an apartment building or vice versa. It doesn't have to be in the same state. This is all covered under section 1031 of the IRS code. If I have to pay for any personal property in the new building, or the new building actually costs more than the money I received from the old building, then I have to put some money into it, then this is called boot, to even out the values. And it is taxed, and it is taxed by, it is the buyer, sorry, the seller rather, that has to pay the taxes. So boot is subject to taxes on the receiver of the proceeds. And we've got some questions here which I won't go through. And that's the end of chapter 18. So thank you very much. It's a little bit of a long video, but it is a long chapter.